You need to look at your screen right now, not later, not after this video ends. Open your brokerage app. Look at the number flashing next to silver. It looks clean, it looks precise, it looks authoritative. A price generated by the most advanced financial system in human history. And it is lying to you. That number is not the value of silver. It is not even close. It is a digital hallucination produced by a system that has quietly detached from physical reality. A system that still prints prices, but no longer clears metal. Because while you're looking at one number in New York, a completely different number exists everywhere else in the world. And the gap between those numbers is not a spread, it is a fracture. When one market becomes three. For most of modern financial history, silver had one global price. You could argue about small regional differences, but arbitrage kept everything tightly connected. If silver was cheaper in one place, traders bought it there and sold it somewhere else. The system corrected itself. That system no longer exists. Today, silver trades in at least three separate realities. One exists on screens, one exists in Western physical markets, and one exists across Asia and the Middle East. These prices are not converging. They are moving further apart. And that should terrify anyone who believes markets still function normally. Why this is not just a premium story. The word premium is comforting. It implies something temporary. A small markup caused by logistics or demand, something that resolves on its own. This is not that. A premium exists when supply is tight. A fracture exists when supply is gone. What we are witnessing now is not buyers paying extra for convenience. It is buyers paying whatever it takes because they no longer trust the system that prints the price. When physical metal trades tens of dollars above paper prices across multiple continents at the same time, the issue is not demand. It is confidence. And confidence, once broken, does not return quietly. The moment arbitrage stops working. In a healthy market, a price gap like this would close instantly. Traders would buy cheap silver in one market, ship it to the higher priced market, and pocket the difference. That pressure would force prices to equalize. But that is not happening. Metal is not flowing fast enough. In some cases, it is not flowing at all. Instead of closing the gap is widening. That means the invisible plumbing of the global metals market is clogged. And when arbitrage fails, price stops being truth. It becomes fiction. Why screens still show a single number? You might wonder why, if the system is broken, your screen still looks normal. Why charts still update? Why trades still clear? The answer is simple. Paper markets can function long after physical markets fail. Futures contracts do not require metal to exist. They require margin, confidence, and settlement in currency. As long as participants believe contracts can be rolled forward, the system continues to print prices. But the moment enough people ask for delivery instead of rollover, the illusion collapses. That is the line the system cannot cross. The hidden rule no one talks about. Here's the rule that governs everything you are about to see. Paper prices are allowed to exist only as long as they do not force physical delivery at scale. The moment paper prices rise to meet physical reality, the liabilities embedded in the system become unmanageable. The entities that sold metal they do not have are exposed. Losses move from theoretical to existential. So the price cannot rise freely. That is not a theory. It is a constraint. Why this feels sudden but isn't. To most people, this looks like it came out of nowhere. One day markets look normal. The next day, premiums explode. Dealers run out of inventory. Screens lag reality. But fractures do not happen suddenly. They form slowly, then become visible all at once. The system absorbs stress for years, leasing metal, rehypothecating bars, selling claims on the same ounce multiple times. Each step worked as long as nobody demanded delivery simultaneously. Now they are. What this means, going forward, once a market splits into paper and physical, it does not heal quietly. The gap becomes a signal that price is no longer discovery but defense, a signal that the system is rationing reality. And when markets start rationing reality, the next phase is not stability, it is exposure. What this investigation will prove. In this 4-part investigation, we are not going to predict prices. We are not going to hype numbers. We are going to map reality. We are going to show you how and why the global silver market fractured, why different regions are paying radically different prices, why arbitrage is broken, why the paper price cannot rise to meet physical demand, and why this gap represents one of the largest silent wealth transfers in modern history. This is not speculation, it is already happening. The illusion of a single global price. For decades, the silver market appeared unified. One chart, one ticker, one global reference price that everyone accepted as truth. That price was broadcast from Western futures exchanges and treated as reality everywhere else. But that unity was never real, it was enforced. The global price worked only because physical metal stayed mostly still. Most contracts were rolled, not settled. Most buyers never asked for delivery. The system relied on inactivity more than integrity. As long as metal didn't move, the fiction held, the rise of paper without metal. Over time, the paper market grew exponentially larger than the physical market it supposedly represented. Claims on silver multiplied far faster than silver itself could be mined, refined, and delivered. This imbalance was not hidden. It was normalized. Banks sold futures to miners. They sold futures to industrial users. They sold futures to investors. In each case, the assumption was the same. These contracts would never all be exercised at once. Silver became a derivative of itself. Why physical demand suddenly matters. Again, for years, physical demand could spike without consequence. The paper market absorbed it. Inventories shifted quietly. Leasing filled the gaps. That changed when buyers stopped treating silver as an investment and started treating it as insurance. Currency instability, geopolitical fragmentation, and trade weaponization altered behavior. Buyers in Asia and the Middle East were no longer speculating on price. They were securing supply. When buyers stop caring about price and start caring about possession, paper systems fail. The East-West divide becomes structural. This shift happened unevenly. Western markets remained confident in contracts, clearinghouses, and cash settlement. Eastern markets demanded metal. That divergence created two different definitions of price. In the West, price meant what the screen said. In the East, price meant what secured delivery today. Those definitions are incompatible. Why arbitrage didn't close the gap? In theory, arbitrage should have resolved everything. Buy where cheap, sell where expensive, move metal, equalize prices. In practice, that required functioning logistics, available inventory, insurance, export approvals, and willing custodians. All of those became bottlenecks at the same time. Metal is heavy, transport is slow, vaults are congested, refiners are prioritizing local demand, export rules are tightening, insurance costs are rising, the arbitrage engine stalled. The moment metal became strategic. Silver quietly crossed a line from commodity to strategic resource, not because governments announced it, but because behavior revealed it. Industrial demand rose sharply in technology, energy, and defense supply chains. At the same time, sovereign and private buyers began hoarding instead of recycling metal back into the market. Once metal becomes strategic, it stops circulating freely. And once circulation stops, price discovery breaks. Why Western prices could not adjust upward. Normally, rising demand forces price higher. But in this system, rising price created a different problem. Higher prices would force paper sellers to confront their liabilities. Contracts written at lower prices would generate losses. Margin requirements would explode. Balance sheets would be stressed. The system faced a choice. Allow price to rise and risk cascading insolvency, or suppress price and let physical drain continue. It chose suppression. The silent drain begins with paper prices held artificially low. The West became the cheapest source of silver on the planet. That created a one-way flow. Metal moved out, slowly at first, then steadily, then visibly. Inventories declined. Delivery times lengthened. Premiums widened. But the screen price barely moved. That divergence was the fracture forming beneath the surface. Why this was inevitable. Once physical demand overtook speculative demand, the outcome was predetermined. A system designed to trade promises cannot survive a world that demands delivery. The fracture did not occur because of a single event. It occurred because the assumptions underpinning the system failed. Silver was never meant to be printed. What this sets up next. At this stage, the system cannot heal itself. It can only delay. It can ration. It can slow withdrawals. It can create friction, but it cannot restore trust. And when trust disappears from a market built entirely on promises, the next phase is not volatility. It is confrontation. When the market becomes a one-way door, once a market fractures into paper and physical, the rules change for everyone inside it. What was once a two-way system becomes a one-way door. Metal can leave, but it cannot easily come back. This is the phase the silver market has now entered. Western exchanges continue to print prices and clear contracts, but the physical metal that gives those prices meaning is steadily exiting the system. Every ounce that leaves makes the remaining paper claims more fragile. Every delivery tightens the constraint. At a certain point, the system is no longer managing a market. It is defending a perimeter. Why the paper sellers cannot exit. The most misunderstood aspect of this fracture is why paper sellers do not simply close their positions and move on. From the outside, it looks irrational. Why sell silver cheaply if the rest of the world is paying more? The answer is that they cannot stop. The paper market is not a collection of independent trades. It is a layered structure of obligations. Closing positions en masse would require buying back contracts at rising prices. Rising prices would trigger margin calls. Margin calls would force liquidation across balance sheets. What looks like a trade is actually a trap. How suppression becomes survival. At this stage, price control is no longer about profit. It is about solvency. Allowing the paper price to rise rapidly would expose how many claims exist relative to available metal. It would force delivery requests the system cannot satisfy. It would convert a managed problem into an immediate crisis. So the price is capped not because it should be, but because it must be. This is the critical transition. Suppression stops being a strategy and becomes a necessity. Why this cannot be admitted publicly. No institution can openly acknowledge that it cannot deliver what it sells. Confidence is the system's only collateral. Once confidence breaks, paper markets cease to function. That is why the fracture is never described directly. Instead, it is fragmented into explanations. Logistics issues, temporary premiums, regional demand, technical factors. Each explanation is partially true. None explain the whole. The whole truth is unpresentable. Why delivery is the real battlefield. As long as contracts are rolled and settled in cash, the system survives. The moment delivery becomes widespread, the system is tested. Delivery is the only action that forces reconciliation between paper and physical, and that is precisely why it is discouraged through delays, fees, and friction. Waiting periods lengthen, minimum quantities increase, documentation multiplies. None of this is accidental. Why physical holders now set the price. In fractured markets, price no longer originates where trading volume is highest. It originates where metal changes hands. That means price is migrating eastward, toward markets that demand delivery, not settlement, toward buyers who do not care about futures curves or contango. They care about possession. When possession matters more than price, price follows possession. The feedback loop that accelerates the drain. The longer the paper price remains artificially low, the stronger the incentive to extract metal. Every suppressed price is a subsidy to physical buyers. This creates a feedback loop. Low paper prices encourage more delivery. More delivery reduces inventory. Lower inventory increases fear. Fear increases physical demand. The system is feeding the very outcome it is trying to avoid. Why this phase feels stable. Right before it isn't. To outside observers, this phase looks deceptively calm. Prices fluctuate within a range. Screens update. Trades clear. But beneath that calm is tightening constraint. Less inventory. More claims. Longer delays. Systems rarely fail at moments of maximum stress. They fail when stress is masked. That is when participants are least prepared. What historically happens? Next. When fractured markets reach this stage, there are only a few paths left. Either price is allowed to rise sharply to ration demand, or access is restricted to preserve the system. Neither outcome is orderly. Price spikes break paper shorts. Restrictions break trust. The system will choose the path that preserves itself, not its users. Why this is no longer about silver. Alone silver is simply the clearest signal. The same structural pressures exist across commodities, currencies, and settlement systems. Anywhere paper claims exceed physical reality, the risk is the same. Anywhere delivery matters, fractures form. Silver just happens to be small enough, strategic enough, and constrained enough to expose the fault lines first. Setting up the end game. At this point, the fracture is visible, the incentives are clear, the constraints are tightening. What remains is resolution, not in the form of a smooth adjustment, but in the form of a decisive event that forces alignment between paper and physical. That alignment will not be negotiated, it will be imposed. Why fractures never heal? Quietly. When a market splits into paper and physical, there is no mechanism that gently brings them back together. The idea of a smooth reconciliation belongs to textbooks, not to real systems under stress. Fractures persist until they are forced to close, and the force that closes them is never consensus. It is constraint. At some point, the system runs out of room to maneuver. Inventories fall too low. Delays grow too long. Confidence weakens too visibly. What was once a controlled divergence becomes an existential question. Can the system still deliver what it promises? The three outcomes. The system always faces. When reconciliation becomes unavoidable, the system has only a few options. It can allow the price to rise sharply and ration demand. It can restrict access to physical delivery, or it can force settlement in currency and declare the problem solved. None of these outcomes protect participants equally. Allowing price to rise breaks short positions and exposes leverage. Restricting delivery preserves paper markets while sacrificing trust. Forced settlement preserves institutions while transferring losses to holders who believed a contract was ownership. Every path preserves the system by harming someone else. Why the price cannot drift up? Gradually. Many assume that if reality is higher than the screen price, the adjustment will happen slowly. A few dollars today. A few dollars next week. A calm ascent. That assumption ignores leverage. Gradual increases are the most dangerous outcome for a paper-heavy system. They keep pressure on short positions without clearing them. They prolong margin stress. They encourage delivery requests. They do not resolve risk. From the system's perspective, gradual adjustment is worse than shock. That is why fractured markets tend to resolve violently, not smoothly. The moment confidence finally breaks. Confidence does not disappear all at once. It thins. Participants begin to hesitate. Delivery requests increase. Rollover rates fall. Small frictions become intolerable. Then something trivial happens. A delay, a rule change, a temporary suspension, a technical issue. And suddenly, the assumption that paper equals metal no longer holds. That is the moment when the price on the screen loses authority. Why resolution? Always favors the system. When forced to choose, the system always chooses survival over fairness. Contracts are rewritten. Rules are adjusted. Emergency measures are justified as stability tools. The system survives by redefining what ownership means. Those who believed possession was guaranteed learn the difference between a claim and an asset. Those who relied on liquidity learn how quickly it disappears. Those who trusted settlement learn how flexible settlement can become. The market moves on. The losses remain. What happens to the screen price? After the break, after resolution, the screen price often changes rapidly. Either it jumps to reflect physical reality, or it becomes irrelevant as trading shifts elsewhere. In either case, the old reference loses meaning. Price discovery migrates to where metal changes hands. The center of gravity shifts away from promises and toward possession. That migration is permanent. Why this is the end of a phase, not the end of a market. The resolution of a fracture does not end trading. It ends a particular structure. A structure built on leverage, confidence, and inactivity. What replaces it is usually smaller, tighter, and more expensive. Less liquid, more honest. Markets survive by becoming less accessible. The final misunderstanding most people have. Most people think the danger lies in volatility, that the risk is losing money during the chaos. The real danger is believing the system works the way it always has. Fractures punish assumptions more than positions. What this means for anyone still watching the screen. The number on your screen is not useless. It is a signal, but it is no longer a truth. It tells you what the paper system can tolerate, not what the world is paying. The larger the gap between those two, the closer the system is to choosing how it resolves the contradiction. The closing reality, this is not a story about silver alone. It is a story about what happens when financial abstractions outgrow physical limits. Every system built on promises eventually meets reality, not through debate, through force. When that happens, prices do not adjust politely, they snap. And when they do, the only thing that matters is whether you understood the fracture while it was forming, or only after it closed.